Many traders get confused between the concepts of supply and demand and support and resistance. So let's start with that, with the difference between those two concepts. Price movement is often an asymmetric process where many opinions exchange, creating chaotic behavior. Still, every so often, buyers or sellers align on the same opinion and price, which forms a supply or demand imbalance around that price, thus forming a supply or demand zone at a specific price location. Supply and demand zones are advanced concepts of support and resistance. These zones are the areas that show high liquidity and pending orders at a specific price. A supply zone is a price area above the current price where there is strong selling interest. When the price reaches this level, the orders get filled and it moves down. This is a supply zone where many sellers are located. You'll find a lot of selling pressure in this zone, so the prices get rejected. A demand zone is a price area below the current price where there is strong buying interest. This is a demand zone where many buyers are located. There's buying pressure in the zone, so prices will likely advance after reaching it. A significant imbalance in price is created when a large number of orders are filled. Supply and demand zones show unfilled orders of institutional traders. Now, support and resistance levels and supply and demand areas are two different trading concepts that are very similar. They both indicate points where the price can reverse, and you can find them everywhere on the charts. The big difference between the two is that support and resistance often works on historical, older, and tested levels, while supply and demand, especially on fresh levels. Support and resistance trading is particularly strong in multiple touches of the previous levels. Some say that if price has responded to a price level multiple times in the past, that level is significant. When trading support and resistance, the idea is if price reversed multiple times from roughly the same point in the past, then it has a good chance of doing the same in the future. So when trading based on support and resistance, you must identify where these lines are located in the market. You look for points where multiple reversals started from similar prices. Here's a level with multiple reversals. You can see that each of the reversals originated from prices which are quite close to one another. So a resistance level must be found somewhere close to where these reversals started. And here are other reversals. Again, each of the reversals you see started from similar prices, which means there's a support line around here. Now, when trading supply and demand, things are different. If you adopt this concept, you'll mainly look for new zones. A supply or demand zone is a fresh, untouched area where price spent less time. You don't watch in the history of a market for the validity of the zone. You don't wait for multiple retests of the same area. Several big candles and just one base candle could make a valid supply or demand zone. Now another difference. Support and resistance trading is related not only to past price swings. Round numbers, Fibonacci or Gann levels are also areas of attraction and price reversal areas. Price spent a decent amount of time at these levels. Every time price comes to these levels, it tends to take a reversal or a breakout. If price will break the support zone, then the support will become resistance, and vice versa. This is a common trading strategy which is actually very powerful when traded correctly. But in the case of supply and demand, this concept doesn't apply. Contrary to what some may say, a supply zone, which is broken, doesn't turn into a demand zone. I would even say that all support and resistance lines were originally supplies and demand zones. This is how support and resistance are created. They are essentially the confirmed supply and demand levels. So supply and demand are fresh levels, or zones where a price has not been determined yet. Therefore, these levels are valid to trade. Support and resistance are levels or lines in which the price was already determined and changed a few times. Supply and demand traders say that support and resistance levels are somewhat riskier than trading supply and demand. That's because having a zone you can use to watch for entries is much easier than having a level. When price tests the same level, the chances for a breakout increase. Probably the biggest problem when trading support and resistance levels is the fact that price will often fail to turn exactly on the level itself. You know it so well. You expect a perfect bounce, a right to the peep rejection, when you place your level. But oftentimes, price will either move slightly beyond the level before reversing, or will reverse before touching the level. This can make trading support and resistance levels a frustrating experience. And that's the main advantage of supply and demand zones. They offer you an area at which the market should reverse. You don't have to find a reversal signal forming at an exact point like you do when trading support and resistance levels. You have a whole zone you can use to place your trades. As long as the signal was found inside the supply or demand zone, it's a sign that a rejection could follow. Now here's a common mistake. Many traders think because supply and demand is so similar to support and resistance, these zones can cause multiple reversals as support and resistance levels do. While this makes sense, it's not true. Supply and demand zones are a one-time use. After price returns to a zone and reverses, it's better to find another area. The probability it will cause another reversal lowers. The reason supply and demand zones only work once is because they form from the smart money buying and selling. The whole concept of supply and demand is centered around finding smart money orders on a price chart. Price returns to supply and demand zones because the banks have not got all their trades placed or they haven't taken all their profits off. So the reason why zones don't work multiple times is that the smart money have no reason to make price come back after the first touch. They can get most of their trades placed creating the zone, causing price to return, and then reverse. Too many traders put too much attention to older supply and demand levels, while the actual strength hides within fresh levels. Some say that old supply and demand zones have the same probability of causing a reversal as new zones. They say that old zones perform the same as the new zones. There's no difference between them. And when you look at the charts, you may think this is true. Old zones cause reversals all the time. If you go back weeks, months, or even years on your charts, you will find old zones that have caused price to reverse. But let's consider how supply and demand zones form and why they work the way they do. So banks cause a supply or demand zone to form by either placing trades or taking profits. Then they cause price to come back to a zone because they haven't been able to get all of their trades placed or take all of their profits off. But why would they wait months or years to do this? If they placed a bunch of trades because they want price to increase, why would they wait a few months to get the rest of the orders placed? For me, it just doesn't make sense that the banks would wait weeks, months, or years for price to come back to a zone just to get a few leftover trades placed. If they want to get their remaining trades placed or take their profit, they'll make price come back to a zone quickly. They won't wait that long. They'll do it as soon as possible. So, when it comes to supply and demand zones and support and resistance levels, the time factor is going to have a huge impact. Order flow will reposition itself over time. That is a statistical, mathematical factor, meaning that the fresher that supply or demand is, the more likely it is that order flow is still present in its previous form, or new traders will react to it much more likely compared to any historical old price levels. So, simple rule, always focus on what price structures are doing right now on your right side of the chart and not far back on the left side. Fresh order flow will be found in the newly formed structures. If you want to be quick in spotting rotations, that is absolutely a must to understand. So focus on the right side over the left side of the chart. Make this a priority. Sure, historical price action does matter, but near-term fresh price action always should have a priority. Plotting supply and demand should be done with some logical approach. Often, traders tend to pollute charts with 20 or 30 levels, where the whole meaning of anticipating the rejections will lose its value. There is a low value in having a chart completely cluttered with levels, where the trader expects that every micro move of the price should retest some old historical zone and price reacting to it. When it comes to efficient plotting of supply and demand zones on the chart, there are several variables that you should follow. First, number one rule in supply and demand trading: first time retrace to the base is the strongest to enter. Always make sure the zone is still fresh, which means that after the initial creation of the zone, price has not returned to it yet. Also, consider the time spent at the supply or demand level. How much time did the price spend at the zone? The less time price spends at the zone, the more out of balance supply and demand are at that price level. This means smart money are aggressively placing orders. You also want to analyze how far the price moved away from the zone. Look for extremely strong turning points. These are high probability price levels. And I said it before, pay attention to the most recent zones. Have only the nearest ones in sight, and keep your chart clean. Another variable to identify the strength of the supply or demand zone is the volume at which price formed the zone. The stronger the volume, the more important the zone could be once the price retests it. If you want to know more about volume, watch this video next to learn how to identify buying or selling volume, and check out our Academy program if you want to further level up your trading. Until next time.